Welcome to P2 Corporate Reporting. In this section, we are going to look at segment reporting in corporate reports. If you've been following the P2 syllabus up until this point, you will see that there is very little new information. Most of it is the professional application of the material you learned in F7 until now. In this video, we are going to look at IFRS 8, a standard that has not been covered in earlier courses. You know what that means, don't you? You need to know it. So let's go over the main points of this standard. IFRS 8 operating segments requires particular classes of assets, mainly those with publicly traded securities, to disclose information about their operating segments, products and services, the geographical areas in which they operate, and their major customers. Information is based on internal management reports, both in the identification of operating segments and the measurement of disclosed segment information. Why is this information important to the users of the financial statements? Well, it would show what products are performing strongly, or if the company is over-reliant on one product. What would happen if demand drops? What product is it? Is this a likely situation? Also, by giving this information, users can see if the company is looking into moving into new markets and diversifying. The standard defines an operating segment as a segment that engages in business. This can be internal or external. If the person preparing the financial statements considers it important, then it should be important for the users of those financial statements. When looking at an operating segment, separate financial information is available. The results are regularly reviewed by the chief operating decision maker. This shows the segment's importance. So, an operating segment has the following characteristics. 1. Earns revenue and incurs expenses from a business activity. 2. Is regularly reviewed by the chief decision maker when handing out resources. 3. Has separate financial information available. The standard requires that the entity reports financial and descriptive information about its reportable segments. A reportable segment is an operating segment or aggregations of operating segments that meets the following criteria. The segment's reported revenue, both from external customers, inter-segment sales, or transfers, is 10% or more of the combined revenue of all the operating segments. Or the segment's assets are 10% or more of the combined assets of all operating segments. If you have identified reportable segments, but their total external revenue is less than 75% of the entity's revenue, more reportable segments must be identified until at least 75% of the entity's revenue is included in reportable segments. These later segments don't have to meet the 10% quantitative thresholds. If an organization prepares segment reports for decision making, for example, per business activity or geographically, as a rule of thumb, these are the reporting segments that should be reported externally. Again, if these are the reports and the segments grouping that are important for internal decision making, this is the information that should be reported externally. Now, I said an operating segment or its aggregations. What are they? They are operations segments that can be grouped together. There are rules for aggregating segments. because by incorrectly aggregating the information will be lost. Therefore, operating segments can only be aggregated if they have the following similar economic features. They provide a similar product or service. They share a similar production process. They share a similar customer. They have similar distribution methods. They are regulated similarly. The best way for you to remember this is by thinking of an example. So, let's take a sweet factory that has broken down its segments on business segments. So there is the sugar-free sweets division, the chocolate bar division, the individual chocolate division, and the boiled sweets division. The company could segment geographically, say the US, European, and Asian market. But let's stick with the fun stuff, their products. Based on the rules for aggregating, the chocolate bar and the individual chocolate division could be aggregated, as the only difference is their size. Everything else is the same. The other two departments, although have similar production processes, that is where it ends, and they should not be aggregated together. This is because they don't satisfy any of the other criteria. Think about it. Their clientele are completely different, and their regulation is completely different. Sugar-free products will have to satisfy stringent regulations that the hard-boiled sweets don't. So, what is the information that needs to be disclosed for each segment? Profit, total assets and liabilities, external revenues, internal revenues, interest, income and expense, depreciation, profit from associates and JVs, joint ventures, tax, and other material and non-cash items. When this information is being compiled, it should be prepared on the same basis as internally used information used by the chief decision maker. This really gives the users of the financial statements an inside view. There's more IFRS 8 requires that revenue and certain non-current assets are analysed by geographical area and that main clients are disclosed. These would be clients that would account for 10% or more of their revenues. The segment they are in must also be disclosed. So you've just learnt a new standard today. What are its advantages and disadvantages? The main advantages are that it is easy to prepare. These reports should be the same as the annual management accounts. The segments that are reported reflect the organisation's business strategy, which will give the users an indication of where the organisation is headed. The disadvantages are selecting a segment can be quite subjective, so there's no consistency. Since this is internal information represented, it can be difficult for users to follow. Again, this is lacking in consistency. It could make the statements less clear and result in information overload.